All right. Good afternoon, everybody. Thank you for joining the Art of the Pitch. I'm Amber, and I head up marketing at Laika. We help businesses of all sizes get and stay compliant, whether that be PR, HIPAA, or a range of other compliance frameworks. And what makes Laika difference is our end-to-end approach that not only encompasses the program design and audit prep, but also integrates expertise, product management, and the project management and the audit itself into a seamless compliance experience. I joined Laika just about a year ago on the heel of our Series B, and since then, we have more than doubled our revenue, and the reason we're all here today, raised our $50 million Series C round. So today, two of our three co-founders, Austin Ogilvie and Sam Li, will share a bit about what that journey has looked like from their perspective and from the fundraising lens. Before we jump in, I just want to mention, if you have questions, feel free to pop those into your right side toolbar over there in the questions section. Most likely we'll address some of those organically as we move through the dialogue today, but if not, we do have some time reserved at the end to open the floor for question and answer. And we will not be using slides today. You'll get to look at our lovely faces. You're welcome. So just so that you know that there will not be slide content that you need to be worried about. Okay, let's get started. Austin and Sam, can you guys both give us a brief introduction?
Oh,
tell us who you are.
Hello, good afternoon, everyone. Can you guys hear me okay?
Great.
Awesome. Thanks for joining. My name is Sam. Austin and I are co-founder, co-CEO of Laika. Very quickly about myself, I come from an engineering background, started my career at Goldman Sachs as a software engineer, and moved to Google. Before Laika, I was the CTO of a company that I started with a business school classmate out of HBS. It was an insurtech platform called Zinc platform. So long story short, we did pretty well until we didn't do very well. We raised a seed round of financing, the Y Combinator, but ended up not hitting product market fit and had to wind down in 2018. So I then spent a year at Bain Capital Venture as an EIR, entrepreneur in residence. So it's a pretty awesome soft landing for a failed entrepreneur. I basically go to their office and drink their coffee, eat their snacks, and think about new startup ideas. And one of those ideas was this compliance bit, which is a major pain point that I had when I was running my prior fintech company. As small as we're 12 people, and we got a lot of different security and compliance questionnaires as we talked to large insurance partners and customers. And we ended up deciding to get a SOC 2 audit report, which turns out to be a pretty painful experience. And I thought I would have the report in 4 weeks. 6 months later, I'm still scrambling to stitch together a information security policy. I have to take my revenue generating code writing engineers off their day-to-day activities to work on the audit. I really feel like that is a pain point that many fintech, SaaS, healthcare companies will face. So start brainstorming this idea a little bit. And then I met Eva Pitas, who's our third co-founder. She spent 20+ years at Citigroup managing risk, compliance, and IT. And apparently there is a similar set of problems on her side that they want to work with the cutting edge fintech and SaaS providers out there. But many of those younger startups don't have all the infrastructure and the compliance program needed to work with a large enterprise like Citigroup. So we really hit it off and inspired by companies like Carta or Pilot. How can we turn this traditionally very analog experience into a subscribable business, which is what we did here in Laika. Also through our VC connection, I met Austin in early 2019 when he was also looking for the next phase in his startup journey.
Yeah, so from my side, very similar professional background to Sam. Actually, the two of us went to school together. We didn't know each other at the time. And then also got started in working in tech in New York, and ultimately founded a data science company. Incidentally, also did Y Combinator, though in a different batch than Sam. And we ultimately got acquired by a bigger data science company called Alteryx. And when Sam and I first were introduced from a mutual mentor of both of ours at Bain Capital, it was like entrepreneurs love at first sight. The two of us were going to build something together. That part was obvious, and Sam pitched me this idea for standards agnostic information security platform that would make it super easy for people like us to take action on this explosion of security standards and privacy standards. And it was just the right moment for a perfect team up opportunity with him and Eva.
Awesome, thank you. And I know you both each have prior funding experience, but today we want to take this journey when it comes to Laika. And Austin, you've now raised 4 rounds here at Laika. Can you give us just the high level of what that journey's been like?
Yeah, sure. So we raised our first round in the summer of 2019. It was a $3 million seed round led by a VC in New York called Third Prime. The following summer, we raised our Series A from Canopy Ventures. That was a $10 million A round. JP Morgan led our Series B the following summer, 2021. That was $35 million. And this round from Fin Capital, $50 million Series C.
That's amazing. And I know you both shared that the Series C process, it was a few weeks of time to prep, but then really just 2 weeks in terms of having the investor conversations and reviewing term sheets, which I think for me and probably most other people feels like a really fast cycle. And so I know that it's years in the making to build a great company that actually is attractive for investment, but what is the process that you use to even get started, and how did you manage something so well that the cycle time was as short as it was?
Yeah, I think like many things in life, when it rains, it pours. But there's actually a lot of prep work that goes behind the scene before we start hitting the first meeting. And this process is relatively similar across the stage. Obviously, you're pitching to different kind of investors, and you're preparing different kind of materials. Different sections are at different level of fidelity. But roughly speaking, having done this 4 times with Austin, this process, we've sort of get our rhythm on how to do so. I think, first up, it's really about, hopefully a lot of the data you present to the investors, you are already collecting it and maintaining it organically through your day-to-day business operations, right? Obviously, as the company becomes larger, those things become more formalized, but you should have a basic ideas over your growth, your product, and those things. So hopefully, you don't have to crunch too much data last minute before you do the fundraise. But roughly speaking, we spend a couple weeks together creating the following material. The pitch deck. That's really, I think, at some point last year, it went out of fashion that, oh, you can raise money without a pitch deck. But to us, it is not only a great piece of material to share with investors, but also a structured way for us to collect our thoughts and figure out how to tell our story and see where we are in terms of where's our gap and where's our strengths. So I think there are many great resources out there, and seed early stage pitch decks are a little bit different from later stage, but really it's about the problem, the TAM, your solution, your traction, and obviously very importantly about the team. At the beginning, it's just the founders, but then we have a series of awesome executives joining us, and those will play a big part in the pitch deck. So a couple other materials that you want to prepare before you talk to the first investor, because once the ball start rolling, and we'll talk more about that later, you want to group as many investors in a very short period of time. So once the ball start rolling, you don't have time to create additional materials, and you don't want to be in that position. So you want to do as much homework as possible before you have that first meeting. Some of the things that you want to be aware of, obviously sales and marketing metrics, growth numbers, different revenue opportunities, leads by different channels, by different regions. That is very important. Unit economics, ideally, on the top of the funnel, what's your customer acquisition cost, what's the LTV, a little bit down in the funnel, the LTV and the margin, depending on different ways you slice it. Another very important thing that people tend to overlook is customer list. Investors are all very sophisticated, many of them. So they will do their diligence behind the scene without telling you, right? That, yes, I can call up the customer that you give me, like those are probably your best ones, but I'm going to try to also back channel with people that I know. So you want to make sure you have a list of highly referenceable customers who can hop on a call with an investor like at moment's notice. But you also want to make sure that a larger portion of your customers are somewhat aware that they may get called. You want to keep them prepared. And last but not least, two other pieces of key things that I think is very important. Financial model. Obviously, it gets more sophisticated and more predictable as your company becomes larger. And also competitive data. That includes win rate based on first and third party data. So I think this list of things together, a version of it is on the pitch deck, a version of it is on Excel or other appendix, gives you the blueprint of a data room that you want to have done before you have the first meeting. Because once it's in motion, you don't want to be spending time crunching data midnight before your next pitch. And then it's really about curating your investor funnel. And Austin and I do this in an Excel tracker, right? We have our VC tracker, now 4 times. You want to find partners that you like, as well as what we call the path to introduction. Warm introductions are always much better than cold outreach. That's the blessing and the curse of the VC community. Like, you will want to find your way in. In general, we prefer other entrepreneurs to make those introductions, which to be great, but obviously your existing investors and anybody in your network would be helpful. And you also want to position, you want to be aware of the level of individuals you are talking to, whether it's the principal level, the associate level, or the partners directly. And lastly, before we go into the meeting, it's really about timing. And this is one of those moments where micro timing is extremely important, because you never know, when term sheets are going to arrive, and momentum matters a lot in a very short period of time. So Austin and I have done this a couple of times, and hopefully we're getting better every time. But we have a group outreach in a matter of the week leading towards when we want to book meetings, and we group all the meetings in ideally like a 2-week period, where obviously this is kind of a battle war room situation. We take 4, 5, 6 meetings every day, but that micro timing is really important, because you want to create that short period of windows where you run your own process and induce people to do diligence in a very short period of time. So I pass, that's kind of what leading towards the pitch. We'll talk more about the art of the pitch itself later, but I'll let Austin talk about some other tips and tricks once we're getting close to term sheets.
So when it's always a good day when the first term sheet in a fundraise lands in your inbox, and definitely in the very beginning, you want to be moving towards written terms as quickly as possible. Obviously, when you get a term sheet, it's useful not to react in the moment. So often you'll be on the phone and they'll send it in real time. Take a deep breath, don't react to it. You need to use that term sheet to generate more. It's probably the most useful tool in generating additional term sheets is the first one. So buying yourself time. Hopefully you're talking to investors that are not going to write you an exploding term sheet with a expiration date of a day. Generally speaking, they won't actually pull the term sheet if it's written that way. So again, take a deep breath, find a path off the phone if you're on the phone, socialize it with your board if you have a board, and immediately it's an outreach. Ideally, Sam and I always do it by phone to call the next sort of most advanced investors that you've been talking to. So if you've done, like Sam mentioned, like the first 2 weeks of meetings, we really try to jam a lot of calls into, and ideally do it by phone. It's quite time consuming to do these first meetings in person. But ideally, if you've squished a very high volume of initial and maybe second or third investor calls into that 2-week period, once you have this first term sheet, there are logical people that you call next and let them know, look, we're talking to great investors, we got a term sheet, we're not going to make a decision tonight, but obviously it's our fiduciary duty to socialize this deal with the rest of our board and get everyone's thoughts, and like, it's a good deal. just make sure that you communicate to everyone else who could plausibly furnish you with a second or third term sheet as soon as possible, really. And don't tell them who it's from. Don't tell them the terms, obviously. And in parallel, you're also, you send it to your lawyers. Obviously, you need them to see it as well. If there are provisions in there, like the first time you do this, the second time you do this, you're still sort of learning what all the mechanics are. Hopefully there's no red flags or too many hairs on the term sheet. But at that point, you're sort of negotiating. And we try to drive towards everybody submitting term sheets on a certain date. So saying things like, look, we got this one offer. We're trying to get anyone else who's interested to submit their offers in writing by a certain date. What else do you need to see between now and producing your offer? And if it's an unreasonable list of additional diligence materials, maybe you say goodbye to that investor. If they're already quite close, you make a judgment call to dive in a little deeper. Once you've signed a term sheet, that kicks off the closing process. Typically 30 days is the norm. And it's a lot of, basically you have to produce all of the material contracts the company's ever signed, all the employment agreements, all of the proprietary inventions agreements. The lawyers will be working on the final subscription docs, which are huge. The term sheet is very simple. Usually it's just one page long, but the deal docs are, additional sort of negotiation points through the next 30 days until closing.
That's, yeah, a lot of information to gather and consider, so I can understand why the prep is really critical, especially when you're trying to drive urgency on a quick turnaround. You both mentioned investors. Obviously, there's a lot to consider with the term sheet and the details of that, but what about the partners we choose? How do you think about who's going to be a great fit, and does that change on the stage of the round or where the company is?
Definitely. So for different founding teams, we'll have different answers to this question. Obviously, I can speak from our perspective. In this particular round, we were looking for a couple things. One, Laika is stepping into a growth phase, which is quite different from the early stage. So we're looking for investors that have deep funds, investors that are more calibrated towards the larger size investments generally. And then secondarily, we were looking for investors that were very close to our customer base, which tend to either be in regulated spaces or tend to sell by and large into regulated spaces. So Finn was a very logical lead for us in a number of respects. And then Santana is a growth-oriented fund. And then as far as the stages, absolutely, the round composition, you definitely want to think about differently at different stages. From our perspective in the seed round, just for instance, it was very important to us that we have a non-trivial portion of the round allocated to operators, CEOs, CTOs, other founders that can help us along the journey, and not just providing capital, but like people who really know either our customer base, our sales motion. They're familiar with technical challenges that we anticipated encountering ourselves, and all the rest. And then also, we wanted a seed fund to really ground the round rather than one of the bigger funds. But again, there's probably a dozen right answers to this question, depending on who you are and what your business particularly needs. But thinking through and being calculated, like not everyone's money is exactly as green as everyone else's. So being thoughtful about it, I think, is a huge thing.
Thank you. We are already at 20 minutes past, so I'm going to jump into the next one, which I think is probably on many people's minds, which is the funding climate, right? According to Crunchbase, early stage investments, meaning seed to Series B, those are still actually looking pretty healthy, and in fact are at or above 2020 levels. But these later stage investments like C and beyond are much harder to come by. So as you went through this experience, what did you notice anything? Did you do anything differently in the process with kind of that economic climate in the background? Did you notice any different sentiment from the investors, or how is it different given the current times that we're in? Sam, you want to take that one?
Yeah, so I think there's definitely changes in the economy that is impacting everyday fundraising. I would almost view 2021 as a special year, and we're really just coming back to what it should be, which is a little bit more grounded into the fundamentals. People are spending a little bit more time in the analysis. So I think from our perspective, we're lucky that Finn, who lead our latest round, is a relationship that didn't start 2 days ago before we pitched them, right? Like we have been friends and in the community for a long time. So which this shows that relationships takes a long time to build. Yes, the pitch happens in a very short period of time, but many of those investors are longer term relationships that hopefully you have built throughout your journey as a startup founder. And then in terms of the actual process, I think there's obviously more focus on what they called efficient growth, right? Instead of just pure growth. They're looking for healthy customer acquisition cost, better unit economics, better gross margin. Obviously most startups are not profitable, so that's not an expectation, but they want to see some path towards healthy unit economics and sustainable customer acquisition cost. I would say the dynamic doesn't change, right? You still want to have a lot of meetings in a short period of time. You still want to do a lot of the prep work in advance. But one additional thing to think about is to plan a little bit ahead, right? Usually, in the prior years, you can rely on, when I'm 12 months, less than 12 months runway, I can relatively predictably raise the next round. That may or may not be the case. So you probably want to consider raising more and raising earlier, even at some cost of dilution.
Thank you. And Sam, I think your point that 2021 is probably really more of the outlier is a nice transition to this next question, Austin. When thinking about valuation, I think we've seen just crazy valuations, and the market is kind of right sizing that. But when it comes to thinking about valuation in this process, what tips do you have, or how did you think about and approach that here?
I mean, again, different folks will have different philosophies on this. From our perspective, valuation is one important mechanic in any deal, but it certainly isn't the only one that we wanted to optimize for at all stages. Frankly, since the very beginning, each of the term sheets for the 4 deals essentially inherited from the prior term sheet, and so we have a very clean setup. If you exchange valuation for other sacrifices, they can rear their ugly head in unpredictable ways, in ways that could make you quite sad in the long run. Paying attention to things like anti-dilution protections and voting rights and board composition and any number of different things that they're not ever in the TechCrunch articles, but they are very consequential. We take very seriously. That being said, you obviously don't want to needlessly dilute yourselves. So being thoughtful and pushing for a good deal commercially is a huge part of this. But from our perspective, it just isn't the only thing. And certainly in the earlier rounds, we didn't optimize exclusively for valuation.
Thank you. And we had 10 minutes earmarked for questions. It doesn't look like we have any questions in the chat box, so I'll keep moving unless or until someone posts a question in chat. So this webinar is called The Art of the Pitch. So we've talked a lot about the prep, the process, the stats, the funding climate, and all of those considerations, but we didn't yet talk about the pitch. So what was the hook? What was the story that we crafted, outside of building an attractive business from all those other perspectives? What was the hook that got us this 50 million?
It's a number of different things. I think investors are generally very excited about the commercial opportunity that is in the wake of increased regulatory scrutiny and just industries generally paying way more attention to security and privacy and what those two dimensions can mean from a brand perspective. And there's just enormous tailwinds behind these digital security and privacy standards. And it's no longer just Yale New Haven Hospital and Citigroup that are scrutinizing their vendors, it's literally every company on earth is taking this stuff seriously. So, we're doing something really special within the space, unifying one solution to tackle all of these different standards for producing essentially costless verified compliance across all of them. And there's a unique data artifact that comes out in the wash on the back end, which is, we're mapping the entire software ecosystem with respect to verified compliance.
Thanks. Yeah, I mean, it definitely helps to have a great product in a great market. Any last minute tips? Any last tips you want to share, Sam, for the audience? Anything else you feel that we should leave them with?
Yeah, I think kind of similar to what I said, the art of the pitch, there are many work that are leading towards that. And one of those is the relationship that you have with your potential investors and the community. At the same time, we are entrepreneurs. We're here to build things that, we're here to satisfy our customers. So to me, at least, over the past couple of years, over those two companies, I think there's a very healthy balance between building relationship with investors and other different kind of financial service providers versus get a heads down focus on execution, right? So what I would recommend is you set some rough cadence, right, a couple times a month or two times a week to have those build relationship with, take some coffee chats, take some folks that outreach to you and start building that relationship. But at the same time, make sure that you do that in healthy dosages, and you have an eye towards the type of investors that are interested in your sector, the type of investors that can potentially lead your future rounds or make customer introductions. So you have a focused approach versus spending the vast majority of time focusing on execution, which is there's never enough time to do.
Thanks. Austin, do you want to leave with a final tip as well?
One thing that I think Sam and I did better this time than we did ever before, that we'll definitely keep as part of our repertoire, is just being very calculated about our timeline throughout the process. So it's pretty easy for the investors to take charge and dictate how this whole pageantry is going to go. And that is not desirable. So you obviously, investors have to do their homework. They have to do their diligence before the term sheet, after the term sheet. There's stuff that they're going to do, but there's a way for you to frame it along the way that you are expecting this number of meetings to take place before term sheets, or you're expecting everybody to submit their bids by a certain date. Being very clear, asking questions like, is there any reason that you would believe that you couldn't meet that timeline? And what else do you need before whatever the next milestone is, before you could produce a written offer, before we could start talking terms? In the closing process, there's tons of confirmatory diligence. And you're not going to get them to completely skirt or skip enormous chunks of their process. But by being really, really clear with what your expectations are of them, you'll get a faster cycle time and a more organized cycle time. And again, really want to maintain the momentum. So that stuff, not only does it save you time and let you get back to work quicker, it also will, induce way more FOMO throughout the process, which, tends to get you a better deal.
Urgency. Create the urgency. Well, thank you both so much, Sam and Austin. This was really fun to do this with you guys. And thank you, everybody who stayed through and listened. I hope we hit on some great questions for you. If you have anything that we can follow up with, please don't hesitate to reach out. And head on over to heylaika.com. We've got some special offers as part of our Series C celebration that we'd love to share with you. Thanks, everybody.
Thanks, all.